In 1949, Benjamin Graham sat down to write the most influential investment book ever printed. He gave us a character. Most people who quote the book never met him. His name is Mr. Market. Today, we are going to meet him the way Graham wrote him. Not the Twitter summary. Not the LinkedIn quote image. The actual character. His mood swings. His pricing logic. And why Warren Buffett still calls this the most important paragraph in the most important investing book ever written. First, the setup. To understand why Graham invented Mr. Market, you need to understand what Graham had survived. He lived through the crash of 1929. He lived through the Great Depression. He lived through bank failures, soup kitchens, the entire collapse of public trust in markets and in the men who ran them. His own investment firm nearly went under. He lost most of his clients' money between 1929 and 1932. He spent the next decade quietly rebuilding what he had broken. He wanted his readers to never feel what he had felt. And so, when he sat down in 1949 to write the book Buffett would later call, by far, the best book on investing ever written, Graham was not trying to teach you how to get rich quickly. He was trying to teach you how to never get poor the way he had. Now, the concept itself. In Chapter 8 of The Intelligent Investor, Graham asks you to imagine a business partner. His name is Mr. Market. He is, in Graham's words, very obliging. Every business day, Graham wrote, Mr. Market appears at your door. He owns half of your business. You own the other half. He has come to do one of two things. He has come to buy your half from you, or he has come to sell you his. Either way, before he leaves, he will name a price. Just one. He does not negotiate. The price is the price. And the next morning he will be back with a different price. Some days, Graham wrote, his mood will be cheerful. He sees only sunshine ahead. On those days, the price he names will be very high. He believes the business is wonderful. He wants to own all of it. Other days, his mood will be depressed. He sees only difficulty ahead. He can see no light. On those days, the price he names will be very low. He believes the business is in trouble. He wants out. And here is the part Graham wanted you to feel in your bones. Mr. Market's price has very little to do with what the business is actually worth. The business does not change much from day to day. A factory makes the same number of widgets on Monday as it did on Friday. The store sells coffee at the same margin. The pipeline pumps oil at the same rate. The fundamentals move slowly, but Mr. Market's price changes wildly. Sometimes it doubles in 3 months. Sometimes it halves in 3 weeks. The business has not changed. Mr. Market's mood has. Look at Coca-Cola in 1932. In the depths of the Depression, Mr. Market priced the entire company at $34 million. The business sold the same syrup at the same margin to the same drugstores it had sold to in 1928. Nothing about Coca-Cola changed. Mr. Market just lost his nerve. Look at IBM in the early 1960s. Mr. Market priced it at 50 times earnings. He had decided computers were the future. He was right about computers. He was wrong about IBM. He paid too much because of his mood. Look at Apple in 2009. Mr. Market priced the company at about $85 billion. The iPhone was already out. The App Store was already running. The fundamentals were obvious to anyone who looked. But Mr. Market was depressed about the financial crisis. He was selling Apple cheaply. Look at the entire S&P 500 in March of 2009. The financial crisis had cut market values in half. Mr. Market had decided every American business was worth half of what it was worth 18 months earlier. Most of those businesses were still selling the same goods to the same customers. Mr. Market was just terrified. And look at March of 2020. The pandemic crash. In 3 weeks, Mr. Market repriced everything down by about a third. The fundamentals of most American businesses did not change in 3 weeks. Mr. Market was simply having the worst 3 weeks of his life. In each case, the same lesson. Mr. Market's price is not the business. Mr. Market's price is Mr. Market's emotion. The investor's only job is to know the difference. Now here is where most modern investors get it wrong. They listen to Mr. Market as if he is an authority. He is on television. He is on the front page. He has a Bloomberg terminal. He shows up on their phone every 6 seconds with a new price. And so they begin to believe that Mr. Market knows something they do not, that his price is the truth, that when the price drops, the business itself is somehow worth less than it was yesterday. Graham wrote the exact opposite. Mr. Market, he wrote, is your servant, not your guide. You are not supposed to take orders from him. You are supposed to wait until his mood is bad enough that he is offering you something cheap. Then you act. Buffett has spent 60 years repeating this point. Be fearful when others are greedy. Be greedy when others are fearful. That is Mr. Market in a sentence. There is one more thing Graham wrote about Mr. Market that almost everyone misses. You are not required to do business with him. Most days, you should not. Mr. Market shows up every day with a price. Graham did not say you have to engage with him every day. He said the opposite. Most days, Graham wrote, you should be content to let him pass. You watch him. You note his mood. You go back to evaluating the business itself. The business is the thing that matters. The business is the only thing that matters. And then sometimes, perhaps twice a decade, Mr. Market will show up at your door so depressed, so convinced the world is ending, that he will offer you something for far less than it is worth. On those days, Graham wrote, you act. You buy what he is selling. You do not haggle. You do not wait for the price to go lower. You take the gift and walk away. This is the rhythm Graham was teaching. Sit, watch, wait, almost never act. Then, when the gift comes, act decisively and go back to sitting. This rhythm is profoundly hard. It is harder now than it was in 1949. Mr. Market is on your phone. Mr. Market is in your inbox. Mr. Market has a podcast and an app and a notification setting. He never goes home. Graham knew this would only get harder. In the 1973 revised edition of the book, near the end of his life, he wrote that the investor's chief problem, and even his worst enemy, is likely to be himself. Mr. Market is just the test. You are the one being tested. That is Mr. Market, the way Graham wrote him. He is a manic, depressive business partner who shows up every day with a price he made up based on his mood. He is on your phone now. He is your servant, not your guide. Most days, you ignore him. A few days a decade, you take the gift he offers and walk away. In 2026, Mr. Market is on the phone of every investor in the world. He shows up every 6 seconds with a new number. He has gamified the act of listening to him. The discipline Graham was teaching has never been harder, and it has never been more valuable. Next episode, we cover the concept Graham built the rest of his book around. The two words Buffett has used as the title of his career: margin of safety. Subscribe.